Nigeria's money market space saw some activity yesterday with the latest Treasury bill auction. Total of about 77 billion was offered across three tenors, 91, 182, and 364-day bills. Stop rates for the 91 and 182 tenors were relatively unchanged, with the 364-day bill seeing a 60 basis point increase from 4.9% to 5.5%. On the fixed income side of things in Nigeria, the window for the first savings bond offer of 2022 is still open for one more day. 2 retail bonds are available for investment during the first full week of every month, devoid of public holidays. The 2-year bond offers a 7.54% coupon, with the 3-year bond offering 8.54%. Minimum investment 5,000 naira with multiples of 1,000 naira thereafter. To discuss further, we're joined by Oladipo Ajayi, Head of Fixed Income Trading at Chapel Hill Denham. Oladipo, good afternoon to you.
Yeah, good afternoon.
And Happy New Year.
Same to you, bro.
We're here to start with Treasury bills. Doesn't seem like there was been much activity on the 91, 182 day, maybe perhaps more on the 364. How are you seeing this latest auction?
Yeah, I think if we look at the dynamics of yesterday's PMA, it's not only peculiar to the short dated, it has also affected the long dated as well. Because if you look at the volume of subscription, it's not what we've been seeing in the past. So, and as a result of that, we saw what happened at the auction, where actually the 364-day paper actually closed about 60 basis points above the last auction. And it tells you the apathy to actually invest in short-dated instrument now. It tells you that investors are actually yearning for better yield. It tells you are going into the new year, a lot of people are becoming more cautious, looking at the fact that if you look at the budget, so it's a lot of people have been hearing that yield will go up, yield will go up. So people are very careful to actually go in when they feel that they might likely get a better return, maybe in a month or in 2 months from now.
See, okay, so can you talk about where the stop rates are? I guess from the investor side, it looks like they're pretty low. But for the government, is that lower costs as far as interest payout?
Yeah, for the government, I think the core part of the core responsibility of the DMO is also to find a way to actually raise funds at a very cheap rate. And but it's alarming that when we're looking at a report that was released about 3 days ago, where what was written on the report was that for last year's cost of servicing debt went up by about 1.4 trillion. So it tells you that it's about 1.4 trillion was not budgeted for, that we actually need to spend to actually fund our obligations last year. So I think one of the core things for DMO for this year is that they want to actually find a way to actually mitigate that, find a way to actually reduce the cost of borrowing. And on the other side of it, investors are also looking for a better return, considering the current return. Look at 90 days instrument has been around 2.5 for ages, and a 182-day paper is at 3.5. So those things are not attractive enough for people to actually push their funds. And I think for a long time, that's one of the reasons why we've been seeing that pressure on FX. Because a lot of people rather want to buy FX to keep rather than investing my money. Imagine you put in 100 million on a 90-day instrument.
Right.
The return is not something to write home about. So.
Exactly. But as far as if the government embarks on more borrowing this year, can you see that affecting yields?
You see, for this year, I think a lot of things is pointing towards the fact that yield is going north. And if you look at the budget, it shows that we are close to about 7 trillion to actually fund. And that has to be borrowed. And the deficit has to borrow. Imagine even it's going to be 50-50. So it means like we're going to raise like about 3.5 trillion locally. So we know what the impact of that will be. It means that the government is ready to crowd the local market to actually raise funds. And looking at the desperation, of course, investors are ready to capitalize on the desperation. And on the other side of it as well, if you look at the body language of the Fed, it has shown that we should be expecting between 3 to 4 rate hike this year. So we are not totally insulated from the global happenings. It means that at a point this year, you expect the MPC to also actually touch the MPR. For me, I'm thinking that we might see up to like 100 basis points this year. It might not be at once,
right.
Maybe twice. So the if part of that is that will automatically affect the yield on government instrument as well. So which will further push it.
Fantastic. We're just putting up images of the latest savings bond retail offer at 5,000 naira minimum investment. Who is that targeted at?
You see, when in 2017, when this instrument was actually introduced to the market, the focus is to retail investors, like pepper seller on the road, people that. So one of the things is that it got to a level that people like that find it very difficult to actually access the bond market. Considering that for you to invest in bond market, of course, if you have to actually go through the primary market, you need close to about 50 million plus to be able to participate in the market. So it's as if you are shutting down the retail investors from that market. And that's one of actually what gave birth to the retail bond. And if you see, one of the things that dynamics for the bond is that the coupon are paid quarterly.
Right.
So what they are trying to do is actually lure people to want to put money in that fund. So that at least you could also help. It's a form of savings. Imagine you at every auction you are investing 5,000 naira, 10,000 naira. At the end of the year, you'd have invested 120,000 naira. That is bearing the fact that okay, there will be coupon payments or across the year. So the target is to the retail investor on the streets. And but how successful it has been, I will not be able to say that clearly because we've not been seeing that traction in that line. At the time, it used to be double digit.
Exactly.
But as we speak singly, and normally it flows in line with the normal bond market. You understand? As the yields continue to go up, now also the savings bond will actually flow in that direction. So before the end of the year, there's every tendency that we might likely see savings bond also trading double digits.
Okay. Yeah. I wanted to put up, I think we've got rates for Ghana. They are, as far as their monetary policy rates. Yeah, okay, so there we go. So as you look at this, so far left of the screen, 12%. Inflation, monetary policy rate 14. At the bottom there, 364-day bill is 16.64. If you are looking, what's your advice for, I guess, a fixed income investor should they look beyond Nigeria to other nations? You see,
if you look at it critically, at a point this year, Ghana CPI inflation figure dipped to like 7.5. Sometimes in June. And since then, we'll be seeing that upward movement. Even as yesterday, the report that was released is, I think earlier today, I saw 12.6. It has moved by another 40 basis points. You see, currently what is happening in Ghana is it's more like an economical issue.
Yeah.
You understand? As a result of that, they cannot trade the way Nigerian market is trading, where when inflation is going down, of course, yield will flow in that dimension. The Ghanaian market is not that very deep. You understand? So as a result of that, a lot of investors are finding it very difficult to actually go to that market because you're looking at what about when I want to exit? How quick can I actually get out of the market? And also, if you compare Nigerian market to Ghanaian market, I think Nigerian market is more robust. And it's more liquid. It has more depth. So what that simply means is that if you can come to the Nigerian market, you want to dump instrument, there are people that can take it off you. You understand? But that cannot be said of the Ghanaian market. However, and that's one of the reasons why that illiquidity premiums, those are the things that you see in the yield, why you will see the yield far outweigh what we are currently seeing in Nigeria. But are there opportunities in that Ghanaian market? Yeah, there are a lot of opportunity for anybody that actually wants to take advantage of the high yield. But you and I know that going to another currency means that you're exposing yourself to liquidity risk, to exchange rate risk.
Yep.
So exposing yourself to exchange rate risk means that what if the Ghanaian cedis actually now depreciated more against the naira, and the depreciation actually outweigh the return spread that you are getting on? And I think sometimes people have this kind of own bias when it comes to investing. They just want to stay in their cocoon, stay in their terrain where they understand very well. So, but if you want to look at it vis-a-vis, I think there's still opportunity in Ghanaian market for anybody that want to do more like a 364-day paper, which is a 364-day paper is close to 17%.
Right.
So it's not so bad.
Okay, good stuff. Coming back to Nigeria, I guess if you look, it's only January, but looking ahead as the year progresses, what other triggers could move rates on the fixed income money market side?
Look, like I said earlier on, one of the things that will move rates is MPC decision. Yeah. That one is key constant. Another thing that could move rate is the possibility of that happening is very, very slim, but it's not impossible. it's at the end of the day if the government decides to remove subsidy. So if they decide to remove subsidy, we'll see the impact on that on inflation. And as inflation is further becoming more aggressive, you expect the monetary policy guys to be more hawkish in their stand to actually curtail the inflationary pressure. So as a result of that, we will likely see yield also following suit. So for me, I think even the electricity tariff too, that's also a factor that we need to also consider as well. So if we decide to actually remove the electricity tariff stuff, adjust it to market, the impact of that will also affect inflation, which will also affect the market generally. So this year is a very, very, it's a year where most investors want to trade cautiously, considering that we are not totally absorbed of what is happening in global economy. So whatever the Fed saves, one way or the other will have impact on our market, directly or indirectly.
Fantastic. Thank you for that breakdown. Okay, I know we've talked fixed income here, but I'm sorry, I want to ask you about equities a bit. The Dangote share repurchase. How, as far as that procedure is going forward, what's your take on what the company is doing with the share buyback?
I think for me, I think the reasons for the buyback is strategic.
Okay.
It's not something that you can clearly see, because looking at their books, it's not that Dangote is sitting on heavy cash that will likely necessitate the reasons for them to now want to do more like a share buyback. But I think things like that happens when you look at your stocks and look at it that is not appropriately priced. You feel that the value of your stocks actually outweigh where it's currently trading in the market. So what you want to do is that I would rather buy it for myself, since the market cannot see the value in what I'm doing. And I think that's exactly what Dangote is currently doing in the markets currently.
Great stuff. And then I also want to ask you about this reports from Sweden about the number of NMSMEs that closed last year, the impact of COVID. Can you see a recovery for small businesses as we move forward in this country?
You see, for small businesses, there's a lot to be said about them, because the first thing for them, they need infrastructure. You and I know that. They need access to funds. Because for you to actually get funds, finance from banks, it's actually very difficult. Right. Speaking. So I think the banks also need to work hand in hand with the government to find a way to actually give room for small-scale business owners to be able to access funds at a cheaper rate. And I know the CBN is doing their part on by rolling out different programs. You understand? But I think the CBN cannot do it all by themselves. The CBN also needs to do it in collaboration with all banks. Because imagine if a small business can actually access bank directly and meet your bank directly and access funds without much requirement, like bringing your mother death certificate and all those things. Yeah. Those things are deterrent that actually affecting their business. And just like what we said, last year is actually peculiar because it's even global. But one of the things that other developed economy enjoyed is that businesses they expect more like a palliative from the government, where governments actually help them. I know people in US that actually got a huge sum of money to actually help their business to reduce the shock on businesses. And for us, I don't think the government can actually do that, considering the government's pocket. But however, if we create the enabling environment, I think it will help them to actually recover. And I think the government also needs to be aggressive on infrastructure. You and I know the power is very key for businesses. Yep. Imagine that you want to start a business, the first thing you are looking at is that you have to buy a generator. And you're buying a generator worth of like maybe close to 5-6 million naira. So what is the value of the business that you're already expending that capital expenditure? You understand? Those are the key things that we need to actually find a way to actually bring, to actually solve. By solving that, I think it will be easier for most businesses to actually thrive.
Oladipo Ajayi, Head of Fixed Income Trading at Chapel Hill Denham. Thank you so much for joining us. Appreciate your time.